there's not one best market. That's my theory. There's a market for everyone, every investor or every sponsor is going to have a competitive advantage for whatever reason in a different market. And every investor may have a reason to invest in a market that maybe is not the best one for us or for you.
Welcome to Deal Flow with me, 𝐬𝐻PE, the go-to destination for private equity and real estate professionals, including institutional investors, sponsors, and market experts. Each week, I talk with industry insiders on everything real estate, capital, and prop tech. Today, we're excited to have Bernard Pierson, co-founder and managing partner of EHP Capital, join us. Bernard brings a wealth of experience in real estate with a specialized focus in multifamily investments, where he has invested in over 1,500 units across more than 20 assets and currently holds a management interest in over 700. His career also spans significant achievements in real estate development, including leading projects that have developed over 100,000 square feet in condos and single-family home communities. Throughout his career, Bernard has been an influential figure in real estate, participating in high net worth mastermind communities and exclusive investment groups, constantly staying ahead of business trends. Bernard, thank you for taking the time to be with us today.
Thank you, Michael. It's great to be on here.
Yeah, it's great to have you. I think even though I gave you kind of a little bit of an intro, if you wouldn't mind, just from your own words, just give me a little bit about your background, your experience, and what you're focused on today.
Yeah, sure. So I'll start at the beginning. Basically, I was born in Miami, which is where I live now. But my parents were living here at the time. We're from Nicaragua, my family is, and they were living here at the time when I was born. And then eventually we moved back to Nicaragua when I was a kid, and I grew up there, right? So my background is pretty much from Latin America, and I went to school there and everything, and then eventually came back to the U.S., did some food trading, and eventually moved into real estate development. And for the last 8 years or so, just moved on to full-time, I guess, multifamily acquisitions, which is what we do now.
Great. Well, that's a short and sweet background. So that's an interesting kind of. There's probably a lot in there that we didn't hit. So could you maybe go into a little more detail? So you grew up in Nicaragua, and then you moved back. When did you kind of move back to the States? When were you? How old were you then?
So when I came back, so I would always come back and forth. My parents lived in my grandparents lived in DC, so we would go often. And we would always come to Miami and whatnot, which is where I live now. But I moved back full time, I guess, when I was 18, just to come to school here. And when I was born, Nicaragua was going through a war and whatnot, so that's why I was here. And then we always, we were still in the rebuilding phase. We still are today, and if anything, we're back building. But it was just a pretty much back and forth. But then when I was 18, I just kind of moved here, and I never went really back full time. I do go back often to this day, but once I turned 18, I basically stayed in the U.S. We did a lot of work in Latin America. At the very beginning, and it all started with, okay, so I have relationships down there, right? Because that's where my friends are, my family is. So it'll be easier to do business down there, I guess. And I got into food trading. We did a couple of transactions here and there, selling coffee, beef, and other products to kind of broker them in the middle. And pretty quickly figured out that was very transactional. And that's how I got into real estate. I'm like, okay, we're making good money here, but it's just very transactional, right? It's one deal at a time. And then eventually got into ground out development with some partners, and pretty quickly figured out that was also transactional. But because we would build, at least the one we were doing, right? Because we were selling condos and single family homes, and we were building communities of single family home communities and small condo buildings, and they were all for sale, right? There was no multifamily or any commercial or anything for rent or anything like that. So we would build them and we would sell them. And when we would finish out a project, after a lot of risk that we would take and a lot of stress, we would have to start all over again, right? And I figured out, well, I got into real estate to avoid this transactional thing. So what am I doing here, right? So that's kind of when I just switched full time to multifamily. And this must have been in 2015 or so.
Okay. So moved from the development game to multifamily in 2015. That's a good time to have started in multifamily for this cycle, I imagine. So I guess tell me the developments that you were doing were those based in Florida as well as where you're based, or kind of what did those first few projects look like? And then
So most of that was in Costa Rica and in Nicaragua. So I would travel weekly, every week. My wife is from Venezuela, but she lives here. Like we met here, right? So we were living here in Miami. So when I started doing this, I would just basically travel every week, Monday through Friday, to either Costa Rica or to Nicaragua, and I was around the ground. We did a few projects, and yeah, it wasn't really. We didn't do much in the U.S. We did a couple homes here and there, spec homes and stuff like that, but nothing too big. Our bigger projects were down there, and we started noticing what we were in parallel. I was doing a lot of LP investing with other sponsors, either as in multifamily, most of it probably. Also did some office, industrial, all of the above, right? And I started noticing that after a lot of analysis and looking at a lot of data and numbers and experience, right, we were taking on a ton of risk. We call it political, social, just economic risk from these countries. These economies are very different than what we have here in the U.S. And I came to the conclusion that just the risk was not compensating for or the reward was not compensating for the risk. I even started looking at data. When you look at different indices from Latin America and you compare them to the U.S., you basically start seeing that the returns historically are not great, right? There's not a ton of public data in Latin America like there is here in the U.S. where data is a little bit more public. So it's hard to really go into deep dive into the data. But in general, there tends to be, what I was seeing was that the returns were not as great, while the risk was a lot higher and a lot more uncertain, right? There's just risks you can't even measure, that things that pop up out of nowhere over there, be it political or for any reason, right? That you would never think of. And that was kind of like what made us decide that we were going to get out of that. We did well. I mean, it's not like it was a great experience. The deals did well, but we just figured, it would be better to start moving our investments to the U.S.
Sure. And I guess one of the questions I was going to ask was what are the major differences that made you decide to start shifting from Latin American, asset investing to the U.S. You kind of hit on a couple of them: political risk, and kind of other, outsized risks. Any other specifics around like just the construction process, or just anything else around, what makes it potentially more challenging, and what leads to maybe lower returns, in Costa Rica, et cetera, versus say the United States, based on your experience?
So I'll add to. Construction definitely is not as, so when we think about Latin America, we're thinking, what probably costs to everyone's mind, or not everyone's, but a lot of people's mind is, construction is probably a lot cheaper there because labor is cheaper, right? And it is true, labor is cheaper, but just the materials are not cheaper. Materials are not necessarily cheaper. And labor sometimes is more inefficient, where here you see a construction site with 3 people working on it. Down there you're going to see 20, right? And there's more inefficiencies of the whole system, and it's just not necessarily cheaper, right? So that assumption that we may have that construction is less expensive and that we have an opportunity because of that reason is not necessarily true, right? There's a lot of inefficiencies. Everything takes longer, and sourcing materials is not as easy. There's not a ton of inventory. There's a ton here, right? But there's even less down in South America in most countries. And the other thing is these economies are a lot smaller. Just to put it into perspective, the economy of Latin America, like the GDP of Latin America, is 4 times smaller than the U.S. So the U.S. is like even more. It's like 4.5 times larger than Latin America as an economy, while it has half the population, right? So you start looking at all these things, and it's a lot harder to have to sell. It's a very much a less liquid market. Interest rates, we think we have high interest rates here. Well, go to Latin America, they're a lot higher. Like right now, like if we're paying 6% ish, let's say today, that's as good as it gets down there. So ever. So it's just the capital markets aren't there where we get that ton of money. And there is opportunity. Obviously, there's a lot of people that make a lot of good money down there. But in general, that, we were seeing these patterns and that were just not for us.
Sure. So you're hard, takes longer to sell. Construction's not necessarily cheaper. I imagine because income's lower, your rents, if you were to rent them out, aren't going to be as high. So you're looking at similar costs with lower rents or lower sale prices. And so you're going to obviously get
higher financing
and harder and higher financing costs. And are you, I assume you're in those areas, you're dealing with local banks to do those types of projects as well. And that might be, you have recourse debt that you have to take out for those types of things. So a lot
100%.
of less sophisticated capital markets, I guess. Yeah,
100%. You're not going to have a Fannie Mae or Freddie Mac or any of those down there putting out any money.
Right. Yeah. So you decided, hey, let's start doing this in the United States. Tell me a little bit about that, and what was that first project that you did in the United States? What did that look like, or one of the early projects? Because I imagine you started doing for rent product. It sounds like at that point.
Yes. Yeah, definitely. So I had already, as I mentioned, done a ton of, or not a ton, but a few small personal LP positions. So I did get exposed a little bit before I just jumped ship. And I also had a few duplexes and stuff like that, small, that I owned. And as I would come here, I would kind of manage. But quickly, realized that needed scale and started buying some properties in the Atlanta area back in 2016. I want to say 2015, 2016. And those were more 50 to 100 units. We bought 3, and then one in North Carolina that was around 120 units. And always our whole concept was, okay, so we had these issues in Latin America, right? And we could connect very well with this Latin American public. And we really wanted to help these family offices, if you will, or other developers in Latin America that were facing the same issues and were looking to maybe diversify into U.S. assets and investor. And with us being a smaller shop, and we were more flexible in terms of allowing them to JV with us and letting them have a voice to a certain point. We're very selective on who we partner with. And I know I may be getting ahead of myself on where we're sourcing our equity, but we're very selective on who we partner with, because we like to partner with investors from Latin America that have basically been through what we've been and feel the pain that we have felt in Latin America in the past. And they're like, you know what, we want to start expanding to the US, and that realize or see us as the expert and like to leverage our expertise. And at the same time, we're still at that size where we can be flexible with them and offer them more of a JV opportunity rather than just, hey, invest and we call all the shots, right?
Mm-hmm. And you serve as the the active sponsor. You're the main general partner, and then they'll come in but they still have a voice in that partnership. But they're primarily the ones bringing the capital. So you're kind of their access to the U.S. markets and the expert, the on the ground kind of in country expert for them.
That's exactly it. That's exactly it. Yeah, mm-hmm. They realize it's not easy to come to any country. The laws are different. The system is different. That the culture is different. It's just everything's different, right? It's like if you go down to but a lot of our investors are, for example, in Argentina, right? And maybe we're doing a deal in Missouri. Mm-hmm. It's not even easy to get from Argentina from Buenos Aires to Missouri, right? So
it's not easy. I live in Colorado, and it's not that easy to get
right.
So yeah. So
they realize that, and that's basically what we.
Sure. Okay. And then I guess we'll get more into that a little bit. I wanted to step back and go to, you said you talked about, you did some deals in Georgia, North Carolina, 2016. That was definitely on trend, right? That was when a lot of the Southeast United States, the Smile markets were really starting to pick up steam post 2008 to 2012, when the market was pretty dead. And so with all the migration trends and the rent growth and everything, you really kind of got on that train and, kind of early. How did you select those markets? What drove that decision-making process for you guys?
Right. So it was two things. At the beginning, we had partners there that were local, right? And that was very helpful to make that decision. right? To have someone that was more like boots on the ground, and it just made us feel more comfortable with the idea of buying something out of state. For us at that time, it was still a little bit foreign to go buy a building, multifamily property. We were just seeing the migration trends, if you will, towards the south, and we loved all that. We focused a lot on population growth and job growth, and we were definitely seeing that in those areas of the country.
Yeah. So focusing on that, and would you say that were you mostly focused on the fact that you found a sponsor that was local that you liked? So was it manager selection driven, and then you were looking at the market for those population trends, or were you looking for markets first and then trying to find managers that could kind of fit in those markets? Like, kind of what came first?
The manager came first. So I think that there's not one best market. That's my theory. There's a market for everyone. Every investor or every sponsor is going to have a competitive advantage for whatever reason in a different market, and every investor may have a reason to invest in a market that maybe is not the best one for us or for you, and maybe that explains why there's people doing business in parts of the world that just doesn't make sense, right? There are markets out there that have declining population growth and have declining job growth, but they're still building, they're still moving, right? So why would anyone do business there? Well, they may have their reasons. I'm not saying I would go there, right? And it's not our market, but I think it's not a one size fits all, right? And for us, these markets make sense. Our investors were looking to diversify. So going back to your question, the market selection did come after. It was more important to get in with the sponsor that knew what they were doing, right? Because we still were pretty new at the game, and we needed a little bit of hand holding and more of a co-GP kind of arrangement. And going in with the right sponsor was definitely a priority. And then what we were looking for was diversifying and going into a higher cash flow market than maybe Miami was at the time, which is where we were local at. And Georgia, if you will, checked those boxes, at least the cash flow part, which was important back then to our investors, it checked it back then. And yeah.
Okay. Yeah. And so it sounds like since then, definitely, I imagine it's evolved a bit. So, in the beginning, you had this co-GP, you were looking for that local sponsor. Has that changed? Is that still your strategy where you're looking for local presence and you're sort of selecting managers? Or are you guys changed that model at all? Like, how are things have developed since 2016, 17 when you were buying those first few assets?
Yeah. So it's changed a lot. Now I have a partner now. Back then I didn't. And my partner lives in Kansas City. So we do have that local presence in Kansas City, which is basically our main market today. It's not where we own all our properties, but it is where we own most of our properties, and it's where we have most of our deal flow. So we do value that local presence, and we have it. I guess we have it ourselves now, and we have the experience. So we're Kansas City is, to answer your question, we're pretty much focused in that kind of like Missouri area, and not to say that we don't occasionally. We look in Charleston, we look in other parts of the country as well. That's because we do feel confident in those areas because we own property in those areas, and we feel like we have a handle of it in terms of property management, and we just have the right team in place. But having local presence for us, for the size of the deals we buy, we're not buying 250, 300, 400 unit properties, Class B plus A. We're not buying that stuff. So we're mostly buying, 100 units maybe that are Class B. And we found that for that property type, having local presence can be very helpful.
Mm-hmm, mm-hmm. And beyond the partners, having a partner in those markets, do you property manage your own properties, or are you using third-party managers, or how is there kind of company set up in that way?
We do in-house property management. So yeah, so we have property management set up in Kansas City in that area, and any property that we own within, I would say, a 4-hour radius, we're currently managing in-house. If it's outside of that, we still use third party. And so the way we look at it, we feel comfortable buying, like we may have a family office from out of America that says, hey, look, I want to, invest $2 million, right? But I don't want to have any other investors. I want to be the one LP. Well, then that's going to limit to, the size of the property that we can buy. Obviously, that may get us into a 30 unit or 40 unit or 50 unit, depending on the deal. And we can in Kansas City, we feel confident and we feel comfortable going after those deals just because we have the structure. Now we would never do that outside of Kansas City because it's just too small. So now a lot of our partners do invest 5, 6, 7 million, and and that's where kind of like we end up more in the maybe the 100-unit kind of complex. Because
are most of your investors looking to be that sole LP versus being kind of mixed in with some other folks? And I guess what do they see as the perceived benefits or of being the only LP, so to speak, versus being a percentage of the LP base?
So so what we're usually most of the time they're going to be the sole LP. Sometimes we will have smaller LPs come in that are more like the syndication or retail level investor. But as a bigger LP, they're usually the sole LP and they'll fund 60, 70, maybe up to 90% of the equity. And they really prefer that model because they see us as partners and we see them as partners as well. And that's kind of the way they get their voice or it is the way they get their voice. And so I think that what they're thinking is they don't want another cook in the kitchen that they don't know, maybe making decisions. And not that they make a ton of decisions. We're very selective on who we partner with because we don't want someone to come in and get nervous and maybe sell for no reason. And then we structure our operating agreements and everything correctly to avoid any of that. But we're still very relationship driven with our investors, and it's very important for us that they understand what we're getting into, and that we don't want anyone to get emotional if things were to go sideways, or even if they go great. Like sometimes it's not always about just making emotional decisions, or it never is actually about making emotional decisions. So that's why we're very careful on who we partner with.
Yeah, and with property, you're dealing with a lot of people, and so there's always something that comes up. You can guarantee that there'll be something unusual or unexpected to come up on a regular basis when you're dealing with large property and a lot of tenants and you have employees, and so it's a people game. So it's unexpected.
And to them being the sole LP, I think they see the benefit that at least we can have, like, if for some reason they want to have a liquidity event, at least we can sit down and talk about it. And it's just a one-on-one conversation. We don't have to bring in 5 people, or maybe we have to 1031. Well, it's a lot easier to 1031 out if it's only 2 of us, us and them making the decision versus bringing in other people. And also they don't necessarily, or they may not know who the other investor is, and maybe they don't feel comfortable partnering with someone they don't know, right? They're also very selective in partnering only with people they know.
Is there anything unique or about bringing in outside capital from outside of the country into these U.S. assets from a structure perspective that'd be different than if you were bringing an LP from inside of the U.S.?
It is very different. The way most of our investors are big enough where they form their own structure. So they do their thing, and for us, they become a U.S. investor. They basically form a U.S. entity, and then behind that, they have walkers and whatnot that eventually gives them the most tax efficient and legal efficient or protection that they can get versus just investing personally, if you will. So to your point, that's a good point, because part of the reason we ended up JVing with these bigger, if you will, investors or these larger check writers, and $1 million to $5 million, or our biggest check writer is probably topping off at around $10 million. And organically, that $100,000 to $200,000 investor was really not coming through, because by the time so let's say they're going to LP into our deal, right? By the time they talk to a CPA and an attorney, and they tell them, look, this is the way you have to structure it. Well, they figure out first of all, it takes them too long. Then it's so expensive. Exactly. So
you either have to set something up, right? You have to set it up for them and then bring them all in, or you have to have an entity that's large enough that they already have a structure, which is kind of the way you are.
Correct. Yeah. So because the other option, to your point, exactly, you just form some sort of offshore structure that they can go into, and it's already efficient. Yeah.
Very good. So switching a little bit from structure, let's talk a little bit about the market today. Bringing it to today's world. We had COVID. Then we had the Fed increasing rates. Now the Fed is maybe working with us a little bit. Not to say that rates are low relative to they were a few years ago, but we're starting to move in the other direction at least. So what are you seeing in today's market, and kind of what do you see coming up, from your perspective? Are you a buyer today? Are you a seller? What do you see?
We're a buyer at the right price, right? We're underwriting a lot and we're putting in offers. This year we've bought, 2 deals, and we are under contract to close on 1 deal pretty soon here. We are a buyer. So the answer is we are a buyer. We're very optimistic and bullish on the environment. We really like if you can get a deal today, it depends on the market, obviously, right? And I mean, there is still competition in some markets and whatnot, but I think it's a great time to buy. And what we're seeing in terms of the trends in starts and permits going down, deliveries are very high. That is true, but we're definitely seeing a big drop in permits and a big drop in starts that I think is going to be an important tailwind in maybe towards the end of 25 and into 26, and maybe the capital markets help us a little bit. That that part is highly unknown, because if you were asked me 2 years ago where I thought interest rates were going to be, well, I thought that by now we would have probably been a little bit better than where we are now. So maybe is this new normal or not? I don't know, but I do think that at least from an inventory perspective, things are looking pretty good in the future. And it's very hard or impossible to forecast anything, and especially in this industry or any industry. But I think inventory is one thing we can, right? Because we do have access to starts and permits. And that is one thing that we're pretty certain that we're going to be in a better position in terms of inventory, right? And in the next year or so. Now, when you compare all this, all the problems we've had in the US, and you compare it to Latin America, it's nothing. It's terrible. Like in inflation, oh yeah, we were at 9%, right? While Argentina was at 2, 3, 500%. So like when you go down there and you tell them, hey, rates are at 6, what do you think? Are you interested? Like, of course we are, right? Our rates are 20. So, it's all perspective. And I think that things are pretty good here. I think the economy is still pretty strong. I mean, I'm not an expert in this field, but everything I do look a lot into it, and I feel pretty confident in this environment. Now, I like more buying more for longer term. We don't do any bridge debt. We don't do any 3-year or 2-year financing. Our lowest term is always going to be 5 years, and that's pushing it for us. We try to do more 7 years plus. So I think that we get the advantage in real estate that if you can buy with more of a longer term view, it's going to help you mitigate a lot of the risk.
Mm-hmm. Yeah. So that kind of talked a little bit about how you're going to do, how you do your capital structuring, right? So you're looking for long-term holds, you're taking out long-term financing. What does that yield requirement or return requirement look like for you guys, and consequently also your LP investors? What are they looking for from a US dollar return perspective?
Right. Yeah. So if we simplify it, and it's not that sorry. Yeah. So they're all a little different, right? But to simplify it, they're all looking for what we're all looking. It's not like they'll go into a deal with a lower return. I mean, they still want returns similar to what we're expecting here, which is usually that 15 IRR kind of thing that for these regular value adds, Class B kind of thing. So I would say 15 IRR, cash on cash. We're targeting 5 to 6 year one, and then sometimes we go as low as 4, right? But averaging into 7 or 8 throughout the hold period. But we're really focused on our at least our investors, and we do too. We really like buying below replacement cost, which is something we're able to do today, and stabilizing to that yield on cost into like maybe high 7s, even into an 8 sometimes in our market. So we're looking at different metrics that maybe were not as important 3-4 years ago for us, right? And all these, because what happens today is you put a deal into your model, right? And it may not look great, right? It may not always look great, but I think there's that we're all wrong, right? And including ourselves, right? Because we're very conservative with our underwriting. I think we're going to be surprised, and I think we're going to be our exit cap rate is probably going to be better than we're expecting. I think we're probably in a better we're in a very good position to buy, I think, as investors. Now, making that assumption is risky and maybe irresponsible to come in and say, oh yeah, I'm buying at a 6 cap and I'm going to sell this thing at a 4.5 or 5 cap. But I think it's a lot more likely that happens in this environment than buying at a 3.5 cap and then selling it at a 4, which maybe was a lot of the assumptions happening 2-3 years ago, right? So I think we're all going to be very surprised that we were wrong for the good with our underwriting.
Yeah. And I think at that point, there was an opportunity to be much more aggressive with your revenue assumptions, your rent growth assumptions. And so, it was hard to outperform those projections because they were pretty lofty and optimistic. Right now, I think everyone has kind of gone the other way and the pendulum swings to kind of a fear mentality. And so everyone's assuming, no rent growth and, very high expenses and higher exit caps, indefinitely, even though cap rates have gone up pretty significantly, over those last couple of years already. So you're just coming in from a better basis today, better setup, I guess is kind of what you're saying, kind of
That's
a better
it,
setup.
yeah, that's it. Yeah, you said it better than I did. You're almost. It's almost like you're underwriting. Your base case scenario almost becomes your, maybe not your worst because it could always get worse, but it's pretty close to a pretty bad case scenario. And you're forced to get even if you want us to get more leverage, you can't, all right, because the proceeds aren't there. So it's almost like you're forced to be conservative, even if you don't want to. So I really think it's. I mean, obviously you can make mistakes. I'm not saying you can just be reckless and go buy and do anything. You can still get in a lot of trouble. But I think it's set up where a lot of the risk is mitigated. Basis that, as you were mentioning, is huge. I rather buy at a low basis all day and a higher rate than the other way around. Even if it looks better on paper, even if the other one looks better on paper. So, that's in summary, to answer your question, I think that you had asked a few minutes ago, I think we are in one of the better positions we can be today to buy. And we may not see this for some time. It's not easy. It's not easy getting equity. It's not easy finding the deals. But I think that if you got one and you're able to fund it, you're probably going to do very well.
Well, I think that kind of speaks to the reasons why it's a good time to invest, right? When there's lower liquidity and people are less willing and not as bullish, prices tend to be lower and you have less competition. And so you're more able to win deals. Those prices are lower and you're going in with better assumptions. And so it does seem to be more of a recipe for success versus, pre-Fed pivot when, people were buying at those 3 caps and financing at a 3% yield with 90% leverage, right? Or whatever they were doing. So I guess one other thing that you mentioned here on, you're obviously buying under replacement cost, trying to get to a high 7s, maybe even an 8+ yield on cost by, year 3 or 4. And you're financing with agency over the long term primarily. And that kind of drives that year 1 cash on cash, right? Because you're debt service constrained. So you're looking, you're typically going in around that 4 to 6% cash on cash yield in year 1 based on that. Vintage though, didn't hit on that. I know you're looking for below replacement cost, but are you primarily buying 70s, 80s, 90s? Does it, do you have a hard cutoff or is it opportunistic? Kind of how do you think about age of the property when you're buying something?
All right, so our preference is 90s or even 2000s in New York. However, that's not only our preference; it's everyone's preference. So there's a lot of competition in that market. So we are open-minded to that point. And 80s is we may have more of a harder cutoff once we start getting into 82 and below or something, because we start seeing more issues with electrical and plumbing and whatnot. But it doesn't mean we won't buy a 70s deal. We rather not. We try to stay away from them. We've had them before, and we know, we understand the issues they come with. But sometimes there is opportunity there because there's a lot of people staying away from them, right? So we do look at them. We do underwrite them. It's not in our buy box, if you will. If we underwrite them, what we do, we just underwrite them very, very conservatively, higher CapEx, and higher R&M lines and whatnot. But to answer your question, we're trying to stay 90s and newer. So that's kind of like the vintage.
Sure. And then, by, like you said, 90s and 2000s, that's the buy box for, a lot of money, right? A lot of institutional capital, but it also sounds like you're trying to stay sub-institutional on size. So that's kind of where you can be a little bit more, a little bit less competition in the 100 to 150 unit space for 90s and 2000s relative to those institutions. So you're you're competing with other family offices, perhaps other syndicators, but even the syndicators are typically trying to go bigger on properties if they can. So yeah, that seems like a nice space. And it also sounds like you're able to get a decent going in cap rate by being in a non-primary market, not a gateway market in the United States. So you can, you don't have as much institutional capital you're competing against. So Kansas City probably treats you well in that way, and you're able to get a decent yield even going in.
Exactly. So that's exactly the reason why we stay under the 200 unit kind of count. We try to stay purchase price under 25 million. Not that that's a hard cutoff or anything like that, but we have noticed that when we stay below that, we fly more under the radar. There's a lot less competition to buy, right? And that's why we think, or we feel we're getting very good deals. And we have great relationships with the industry in the area, and we have a lot of deal flow in that size, and the kind of like that 100 unit size property, and we can be a little bit more selective, right? Because we do have a good reputation of closing in that area for something that size, and that's why we can be very selective. Sometimes, like, there may be sellers that maybe their loan coming due soon, and they're not willing to just take it to market and see, because there's a lot of people getting stuff under contract and then they don't close, right? And if you have a loan coming due, well, then what do you do now? So that, I think that's given us some opportunity to be the buyer of choice to many sellers in the deals we've recently bought.
Yeah, that I guess speaks to what was going to be my next topic, was going to be talking about deal sourcing, how you're finding deals. It sounds like being a good buyer, respecting the transaction, doing what you say and saying what you're going to do, and just being an honest kind of participant in the market, and that leads to a good reputation, which leads to more deal flow, which leads to off-market opportunities or pocket opportunities that maybe other people aren't seeing. Is that are you primarily going through brokers? Are you going directly to owners? Like, if you just looked at the last few deals that you've done, what do those look like so far as strategies on sourcing?
They've all been through brokers. Some of them have been private listings, to your point, or not necessarily listed. Maybe they shopped it out to a few groups, and we're one of them. One of the deals we recently bought had fallen out of contract 3 times. So we were that fourth buyer who got her under contract, and we got her under contract for actually so the last one we bought fell out of contract 3 times. We were that fourth buyer. We got her under contract for around 15% less than the first contract. And a year ago, we also bought a deal that had been under contract 2 times, had fallen out, and then they came to us and like, hey guys, we need a closer now. We'll take your offer now. And we're like, well, now our offer is a little bit lower, unfortunately, too. So we were getting discounts compared to what they had originally gotten under contract, maybe 20-25% less on that deal. But staying active and putting in those offers has really helped us, even on marketed opportunities. And we'll likely not be the top bidder, just because our underwriting won't get us there. But a lot of the times it just gets under contract, especially in that space, right? Because in the 100 units and even larger. I mean, I guess it happens on every size deal that in this market where they just can't close for whatever reason. And then we are able to close.
Yeah, I think what we receive a lot of that as well, just as I'm watching, various markets, and, those deals where you can be that second or third person, right? You could typically get, and the seller is usually pretty fatigued by that point. Mm-hmm. They're sort of willing to capitulate to the price, right? And, in the beginning for that first contract, they're kind of going for the maximum dollars. Mm-hmm. But, the underwriting, like you're talking about, that supports that valuation is very tight, right? And so 1 or 2 very small changes to the underwriting and the deal blows up. And I think that's what ends up happening, is that they're very aggressive on all assumptions, and then a couple things go wrong and they can't find the equity. They can't tell the story appropriately that they need to tell in order for that underwriting to make sense and for them to raise the capital. And then that transaction sort of falls apart. And so I think as you go from the first contract to the second to the third, you start to say, hey, listen, I just want a fair deal that's at the right price. And because you guys are conservative in your underwriting, you guys can afford to take a couple hits in diligence without losing the deal, right? You have some wiggle room so that you can keep the transaction together. And I think people, during the frenzy of these last few years have forgotten that, if you underwrite to the edge, you can fall off the edge.
100%.
Right?
You're absolutely right.
Yeah.
There are deals out there that we underwrite, because we underwrite everything that comes on market in our market, right? And or almost everything. And maybe we get to just for simplicity purposes to 100 a door. Sells for 120 or 125. We're like, how did you even get there? Like like, how do you get there?
You're looking at a different deal, right? Are you sure you have the right name of the company? Is it the right address? Yeah, it's crazy. And, I think when the market's moving in the right direction, right, the right being up and to the right, I think people can get away with that, being sort of wrong on the basis a bit. But as we've seen, I think from this most recent change in market, people who are buying, if I use the same example, at 125 a door, and they were supposed to be buying at 100, now their property's worth 90, and now all their equity's gone, right? Because they leveraged to 80% of cost, and that's, they're basically trading at the debt. And we're seeing a lot of transactions right now, or a lot of deals right now, in limbo between, losing half their equity to being at the debt basis, or maybe even below that. And then there's a little bit of a confusion around who exactly is controlling the deal today, right? The sponsor thinks they're in control, but when you look at the value of the property, it actually is maybe 5 points below the basis of the debt. And so they haven't quite defaulted yet, but they're on the way. They're sort of like, I guess they call them like sort of zombie companies. They're not, they're upside down, but they just don't know it exactly. And so we are starting to, but it's in this space, unlike the public markets, it's very slow. And so it's slow for people to realize what's happening. It's slow for people to be aware that maybe they don't, whatever they're trying to do is not appropriate anymore, and they have to kind of switch gears. And so we're seeing a lot of deals sort of like, we'll talk to someone, and then 90 days later, we're talking to the lender. Like we talked to the sponsor. Now we're talking to the lender. And it's like, and I'm like, listen, guys, should we just start talking to the lender now? Or, and they're like, no, we got it. We're going to raise more money and, blah, blah, blah. I was like, all right, let's talk in a couple of months and we'll see where we are. But it's,
there's a lot of denial out there.
Yes. But I think we're getting to the point where this year, 2025, there was this saying that went around, survive the 25, all right? And I think, I think we'll see a lot of continued capitulation around, the properties going back to lenders, or just sponsors figuring out how to restructure the capital structure, right? Because there's just the capital structures that they put in place in 21 just don't make sense today. And so, all of that just takes a while, and it takes a lot of conversation, a lot of money moving hands, and a lot of documents have to be signed and everything. So, but I do think that 2025, 2026, we'll start to see the market get a little bit more efficient and liquid and move along a little bit more. And because right now it seems like, to your point, a lot of deals are going under contract, falling out, and for like a year, people are trying to sell their deals. And so I think that represents a great opportunity for buyers like yourself, right? To come in.
I think we're the market's going to start transacting a lot more than it has in the last 2 years, because there's been very little volume.
Yeah. What now? So as we're going into the end of the year, and we're going into 2025, do you guys have, specific goals that you want to achieve for 2025, or, in the near term over the next, over this cycle, so far as, the amount of deals that you want to buy, or anything like that you, that you're focused on?
Yeah. So we used to focus a lot more on, we want to buy a certain amount of deals. And we used to look at it more from okay, we have a goal of buying 100 million or 200 million this year, as an example, right? More than doors, right? Because that we were trying to avoid we really try to stay away from the very C-ish property, or even, or even the ones that they call C but are actually Bs. We really try to stay away from that, and we really stay away from bad neighborhoods, and having my partner being local to the area really helps with that. So we really focus on that median income and whatnot. So sometimes, so that's why we ended up more on our goal is to buy a certain amount, right? 100 to 200 million, let's call it. we have not hit our goal this year just because we weren't, and that's fine. So we've shifted and we're reevaluating if that's a proper goal because it doesn't really own up to our values in terms of we don't want to be a buyer just to buy. We definitely want to buy the right deal. We don't want problems. We're not having any I mean, yeah, we do have issues that some deals that are having challenges. I mean, a lot of us do. But we're not having any major issue with any of our deals. We don't have any bridge debt or any rate cap that we have to take care of or any bridge debt coming due. We don't have any of that. Everything we did in the previous cycle was fixed. So we did stay out of a lot of trouble. So basically now we're shifting into to answer your question, we did not hit our goal of buying the amount of property we wanted to buy this year, but we're fine with that. We rather buy the right property than not. So right now, what we're really focused on is talking to our investor base, mostly in Latin America, and really understanding what they want, what they need, and what's important to them.
Well, while you were talking, one of the questions I had was, what do you consider to be a B asset versus a C asset? Do you guys look at that from a perspective of area, quality, or is that about vintage? Tell us a little bit about what do you think about when you think about a B asset versus a C asset?
So both, right? And also it's going to be vintage. It's going to be area. So we, as an example, where in general, we'll never go into an area that's under 50,000 median household income. However, in Kansas City, that number is even higher. Just because if we go into the suburbs, yeah, maybe we'll go as low as 50, but not below that. But a lot of the deals we bought recently are more in the 100,000 median income kind of level, which is pretty high. For us, a B level asset is also at least at a minimum built in the mid 80s, and even then you're cutting it close. You're definitely your rents are closer to that. They're on the higher, well, not on the higher end of the market, but they're not on the low end of the market. So in our market, that usually means 12, 13, 1400 a month for a 2-bed. It really comes down to that, right? The vintage is going to be very important, but it's still by deal, right? And I know we all have different definitions on what's a B and what's a C. So it's or what's an A or what's a D. But for us, it's vintage is definitely one of them. And median income for the area is going to be very important too.
Sure. Yeah, no, absolutely. Well, I think we're getting here to the end of our time. I wonder if there's anything else that you would like to share with our listeners around, what your, market fundamentals or just golden nuggets that, you've taken away from your career and you've at this point invested in a lot of deals all across the country. Anything you want to leave with our listeners as it relates to golden nuggets or lessons learned?
Yeah, so I think there's a couple things. One is going to be you probably have a competitive advantage, so lean into that, right? And maybe that's your market, maybe that's your location, maybe that's your source of equity, right? And so just lean into your competitive advantage. Not everything is the best deal is not the best deal for everyone. Everyone has different goals and different purposes. So don't think that there's an ideal deal for everyone. So just try to understand what your competitive advantage is and what the right deal is for you and your investors. And at least that's for us, that's what, has helped us avoid a lot of mistakes, now. And because we used to make a lot more mistakes than we do now.
Yeah, no, I think that's well put. I think Warren Buffett always is talking about how, with investing, it's sort of like baseball, but you could, there's no 3 strikes, right? You could take as many strikes as you want and just wait for that pitch that's exactly in, the sweet spot for you. And so you can let 1,000 pitches go by and just let 1,000 deals go by and you just wait for that one that's right in your wheelhouse, right in that market that that demographic, the business plan, all of that's right in alignment with your competitive advantage, your unfair advantage, so to speak. So yeah, that makes a lot of sense.
Exactly. Yeah.
So
there's a lot of people that hear me say that I have relationships in Latin America and I raise capital from Latin America. They're like, oh, great, I'm gonna go do that. It's not easy, right? It works for me because culturally I understand. I know their pain points. I've been there. I mean, I'm not saying you don't do it. You can go do it, but try to find whatever your advantage. Wherever you can fit in or understand it better.
Yeah, absolutely. Well, Bernard, thank you so much for your time and for sharing some great insights and knowledge within the real estate space. If our listeners wanted to get in touch or find out more about you, what would be the best way for them to do that?
You can just email me. My email is bpierson, and Pierson is spelled Pierson. So my email is bpierson at ehpcapital.com. I'm also on LinkedIn, so you can look me up and just send me a message or something. I try to respond to most messages I get on LinkedIn, so I'll be pretty responsive. Happy to talk to anyone.
Perfect. Well, I appreciate that. And so great. Thank you for tuning into this episode of Deal Flow with me, Michael Pulio. Don't forget to give this podcast a follow on Apple Music and Spotify and subscribe on YouTube so you don't miss an episode. And of course, if you feel like someone else would get something out of this show, please go ahead and send it across to them. Feel free to comment below with regards to future guests you'd like to see on the show, or get in touch should you think your knowledge and expertise would make for a great episode. Thanks again from me, and I'll see you the next time on Deal Flow.